Good afternoon, everybody. Welcome to this session. We are live on YouTube, and this session is recorded just for your information. Kindly know that this is a live session on YouTube. So thank you for getting on. It's now 12:59. We will start off with a bit of introductions, and then we can go to the conscious risk talks. I can see we are being joined and we have other people live on YouTube. So welcome to this session for today. My name is Caroline Gadi. I'm the owner and manager at First Idea Consulting Limited. First Idea Consulting Limited is a risk advisory consulting company. We specialize in risk and governance advisory services. And we are happy to host the risk talks. This is our first risk conscious talks. And the reason we are doing this and what is risk conscious talks is that we get a lot of questions on the services that we provide on risk. And one of the things we decided to do is to host risk talks and basically speak about risks that happen in businesses on a regular basis. So this is basically an awareness session on risks. Risk is a preventative service. We get into organizations to help them deal with everyday risk matters. And being a preventative service, it is not well known. And the reason that we're having these talks is to create awareness in the market and also for the market to understand that there are services which are preventative and not curative. So we go into organizations to help them achieve their objectives by providing risk advisory services. So our services are purely preventative and not curative. So the purpose of this, as I said, is to basically create awareness on risk matters, to create awareness on risk, and for people to understand what they can do on a regular basis to be able to understand the matters that prevent them from achieving their objectives. So today we are privileged to be introducing a very important topic on why financial institutions fail. And this is generally financial institutions. And financial institutions are very important organizations to our everyday lives. So we know that financial institutions are important to the economy and to the people because this is where we channel our investments and savings. It is where we are able to acquire money to develop. And their efficiency and stability are key determinants to a country's economic growth. It is therefore important that our finance sector remains stable at all times for it to be able to be the pillar stone of the economy. So today we will be able to speak on preventative strategies that we need to put in place to secure our important financial institutions. And we shall dedicate our discussion on how to make critical institutions stable and functional. So we are basically speaking about a service which is preventative and not curative, like I said. So we will focus our 1 hour discussion on risk and preventative services that we offer to financial institutions to help them remain functional and stable, and for them to be able to function properly and for our economy to be stable. So we will dwell on preventative strategies. We are only going to dwell on preventative strategies and not curative strategies, because that is what risk is. We're going to be looking at futuristic things that financial institutions can put in place so that they don't fail, because we have said that they are very important for the stability of the economy. So today we are joined by Caroline Mutungi. Caroline is a seasoned finance and risk professional, over 15 years of experience in the banking sector. She has worked in various senior positions within the sector. And Carol holds a master's degree in business administration and a bachelor's degree in economics and sociology. She also holds a diploma in management of information systems from Strathmore University. And she has hands-on experience in risk management, credit analysis, and mortgage lending. Overall, she's a dedicated and experienced financial professional with a track record of success in the banking sector. So we are really honored to have Caroline with us. You can see the two of us are Carolines. I don't know if it is supposed to be coincidence. Or So Caroline, welcome to the session today. We are happy to have you and to host you. And I hope that this is going to be a worthwhile engagement with yourself. And I just maybe want us to start the conversation on this very important aspect of financial institutions, and how do we prevent them from failing. And so maybe as we start off, Caroline, I'd like you maybe to tell us what are some of the effects of failure of financial institution in any country? What are some of the effects when a financial institution fails? Kindly mute yourself as you get into the meeting so that we can all hear each other. Thank you. So what are the effects? So a financial institution has failed in a country, and what are some of the effects that would arise from a failure of a financial institution? From your perspective as a banking professional, please have a go at that, Caroline.
Okay. Thank you, Caro. It's a pleasure to have me here today. And we all know that financial institutions facilitate transmission of monetary resources. Basically, they spur economic growth and keeps it vibrant. And without a financial institution, it means the economy of a country is at a standstill. So what happens when a financial institution fails? The first thing that happens is that there is a standstill of that circulation of funds. So it means any customer who was banking or who was a customer in that institution is curtailed from operating their day-to-day lives, is curtailed from living their normal livelihoods. So in the effect is that their lives come to a standstill. Remember, this will have a negative long-term effects in an economy. Why do we say so? That institution will no longer be in a position to give any credit to their customers. The depositor who had left their money there will no longer be able to access their funds. So in short, the ripple effect is broad, and that economy is definitely affected. Remember, also we have individuals who work for these institutions. They also lose their source of income. We also have the people who have probably put investments in the government assets through the banks. It means their access to funds is affected. In short, it affects the livelihood, it affects an economy, and it's not a good place to be. Whether it is a bank or any other financial institution, it's not a good thing, and we must avoid it by every standard.
All right, thank you very much for that. And maybe one of the things would like to speak to, and especially that we know the importance of financial institutions to the economy and the kinds of challenges that it can bring to the economy where depositors are not able to access their deposits, they are not able to access credit, and all those challenges that come with the failure of a financial institution, whether a bank, a SACCO, an MFI, or whatever type of financial institution you're talking about. Maybe let's talk about what are the 5 key risks that would result to the failure of a financial institution. What are the 5 key risks? Maybe we can talk about that so that we really understand how do we then prevent these financial institutions from failing.
Every institution has some costs that they deal with. And one of the things that can lead to failure is unmanaged operational costs. The other challenge is the current, everybody is going digital, everybody wants to land on the platforms, everybody wants their customers to access information online, but there's an underlying risk of cybersecurity, which could mean funds are wiped away in a single day. So that's a key risk that we are looking at as a very current risk that really needs to be well managed. We also have a concentration risk. You find if it's an institution, they only have one key depositor, or you find a few key depositors who, if one morning they wake up and say, today we are pulling out our funds and investing elsewhere, the ripple effect of that is that that institution is affected in terms of liquidity. So what do they use to lend if at all the funds are withdrawn without prior notice? The other issue is you find that there's an aspect of decentralization of decision-making is not common in most financial institutions. And what happens is that when you are out there in the market and you're busy interacting with customers, you're busy engaging customers, you need to create the agility or the freedom to be able to make quick decisions that could affect a business. You find that some institutions, for example, they are able to be very innovative. They are able to allow depositors to use phones to bank their funds. But what happens to that institution that is still rigid and closed up, not willing to open that opportunity? It means it is affected in terms of collection of the SME, the microsector deposits, and in effect, it is affected because it is holding on to the traditional way of doing business. So we require a change of tact. We also have another risk, which is the non-performing loan. We've seen an upsurge of this, especially during the COVID pandemic. A lot of SME customers were affected. So that means they are not able to service their debts. So what does that mean? If a bank was not able to respond to that pandemic by engaging their customers, those banks were definitely affected, and you find that these financial institutions have a huge non-performing portfolio. So in essence, you cannot ignore also the credit risk. The other issue is, of course, the lack of diversity in terms of source of income. Most of these institutions have an overdependency on interest income. What happens if your entire portfolio is wiped out by a pandemic, it's all non-performing, and you've concentrated on just credit and nothing else? That bank is likely to fail, or that institution. So what we are saying is, these are risks that we must remain alive to. We must remain cognizant as we make decisions, and we must ask ourselves as managers of these institutions, as the boards, we must be alive to these exposures and make decisions that will be able to curtail or will be able to mitigate in the event of occurrence. I hope that it doesn't sound very many points, but should be responding to the many risks that we have. Yes.
All right. Indeed.
Then just to clarify, just allow me to add another one on concentration risk. We've talked on over dependency on depositors. We also need to talk about lending. You find that if it is a micro institution, they have an inclination to lending a particular cadre of customers or set of customers. What happens if that sector fails? What happens if that system doesn't work? What happens if those customers are just for one reason or another not able to service their debts? You get affected as an institution. For example, when there was COVID, we saw the tourist industry was affected. Assuming all your loans, like 80 or 60% are on that sector, of course, the customers won't repay the debts, and that will mean that that institution can easily fail.
All right. Wow. Thank you very much for that. And I think that these are major risks that affect many financial institutions. And this is the reason that we have risk management as one of the key services that organizations like this should pick up. So I'll go through each one of them, and we can then deliberate on what risk management would help in these risks that these financial institutions feel. And I'll start with the first one that you began with on unmanaged operational cost as a risk to a financial institution, whether a bank, an MFI, a SACCO, or whatever kind of financial institution that we're speaking about. So we have one of the risks of very high unmanaged operational costs. From a financial, from a risk perspective, kindly tell us what would the risk discipline help in managing these operational costs for this financial institution, Caroline?
Okay. As financial institutions, we must make our people cost aware. They must resonate that every morning for you to run an institution, you have costs that you cannot avoid. So we must sensitize our teams on the ground on the fact that for you to function, for you to run an institution, there are certain costs that you can manage at your level. For example, if it is the operational day-to-day of a, let's call it, for example, we just give an example of a branch. What can we do at that level to cut our costs? We need to ask ourselves, what can we digitize and run away from manual costs and probably reduce on the head counts or reduce on the touch points to ensure that we have fewer people and we have a more efficient system? Do we also establish a reward policy that rewards people who are cost sensitive? Do we embrace a sustainability approach where we have no wastage, zero wastage at our various units? So that's an option that we could take just to see what do we do to reduce every year on year to make sure that our cost projections are coming down year after year. Otherwise, with unmanaged cost, whichever type of cost we are dealing with, we are talking of an institution that will have a ballooning expense that eventually cannot be managed. And that would mean that we cannot sustain that institution. So basically, costs are things that we must be alive to. We must speak to the people that we are working with, right from the top to the bottom. We must also look at how we can digitize, how we can improve our systems and create more efficiency around us to ensure that we tame our costs as institutions.
Okay, great. So, and that is very important, especially for organizations which have many branches or many offices and many employees. I think cost management is critical, and risk management can help you then be able to identify some of the areas that you can save on as you manage your business. And especially when the business is growing much bigger, then we can have a lot of unmanaged operational costs, as you mentioned. And I think it's important to identify things like digitization and such kind of areas that we can be able to save on. And some of these things can be done very well through risk management. As we speak about digitization, it brings to the next risk, the next high risk that you have talked about, which I think is one of the highest risks that the world is dealing with right now, of cybersecurity. And this, I think, is a very key risk when it comes to financial institutions and the reason that they are failing. So what could a financial institution do in the circumstance where we are dealing with cybersecurity risks? So what are some of the interventions that risk management can bring to fore in terms of this very important risk that financial institutions face on an ongoing basis?
Great. Cybersecurity starts from the basic or the behavioral habits of our staff. How do we ensure, or how do we inculcate within an institution the discipline of cybersecurity, whereby we are alive to the risks around us Some of these things just happen when we are operating our machines in our workstations. How do we sensitize our teams to be alive to the fact that they can be exposed at their point of working? How do we protect our passwords and ensure that we don't have you find in institutions, people share passwords, and that's really not an issue. How do we ensure that the issue of protecting our machines, our passwords from external access is done? How do we invest also in the systems that we use to ensure that even accessing a customer's information is well guarded? I've seen some institutions that are able to pair your personal details with your mobiles, just to make sure that you receive an alert, you receive information when access is issued to an account. Essentially, cybersecurity is an issue of also how do you secure customer information. You need to ensure that customer information is well guarded. You need to have a system that is able to guard that information and not accessible out there to members of the public. And basically, you should also be aware that a lot of times when it comes to cybersecurity, customers are preyed in probably by the people who serve them, the people who they interact with. We must sensitize them. We must keep informing our customers. I think we see a lot of alerts in our phones giving us notification, do not do this, do not do that. Let us be alive to this risk as institutions and do something about it. Let's not ignore it, but acknowledge that this risk cannot be avoided. Communicate about it. Sensitize your staff, have policies in place on confidentiality to guard information, and many other things that we could do to stay alert and alive to this risk that is very rampant, but can also be avoided by safeguarding our details.
All right. I think I like the fact that we're talking about securing customer data. And we know that we currently have a Data Privacy Act, which is right now operational in Kenya. And it requires that organizations which are handling information for customers abide by certain rules and regulations. And I think this is an important part of risk management in terms of how do we manage customer information, how do we ensure that customers are aware of what information is held within these financial institutions. Do they have consent for this information to be held within the operations of these institutions? Maybe you can speak a bit about the Data Privacy Act and some of the provisions that we have to be able to secure customer information within the financial institutions.
The Data Protection Act, first of all, prohibits an institution from just releasing a customer information out there. For you to be able to even lend a customer and probably they're defaulting on you, you still have to be very careful when you're reaching out to these customers, especially instances where probably these customers have guarantors and you somehow have to talk to those other third parties. I want to state that this is prohibited and we really need to seek the customer's consent every time that we want to engage other people out there who are more of third parties to a customer's detail. Secondly, we must protect the properties of these customers in terms of data. We must protect them by making sure that the information is guarded, even the status of their accounts is well guarded, to make sure that customers don't feel vulnerable, customers don't feel exposed when they are dealing with a certain institution. And don't forget, if word goes out that there is more of a risk or exposure of information disclosure for customers, if customers suspect of that, that could also affect the reputation of a financial institution, because that what would mean is that customers will run away from an institution that exposes them to potential frauds because of information sharing, because of lack of guarding your systems well, which makes it easier to hack or access by external parties. So in essence, we must guard customers' information. We must only release it with the consent of a customer.
All right, so we know that financial institutions have a very important task to comply to the data privacy laws that are currently operational. And as customers, we need also to know that we have a responsibility to ensure that we understand the kind of data being maintained by the financial institutions, and we have given consent for that information to be maintained. And we also have the with responsibility of requesting a financial institution to withdraw our data from their systems as part of the data privacy laws. I think that's critical, as we also, as citizens, manage our data, and we have the right to be able to manage our data and request organizations on how they can be able to manage our data. So the other risk that you spoke about is a very important risk called the concentration risk, where financial institutions have major deposits by either one or a few depositors. And this is one of the biggest risks that why financial institutions fail. From a risk management perspective, we know that this is a big risk that financial institutions face if they have few depositors or one depositors with a huge deposit in the financial institution. My question to you is, so we have this as a risk they face from an operational perspective from the bank or from the financial institution. What are some of the things that risk management would help this financial institution do to help them with the concentration risk? And maybe from your perspective and from your experience, maybe some of those things that can be done and can be implemented in these organizations. Caroline.
Okay. I would want to emphasize on tapping into the value chain. A lot of times, for example, when you're a lender, you're very excited, you're feeling good when you get this huge borrower. And unfortunately, you find that a customer would easily borrow funds from one institution and remit the funds to another institution, and probably prefer to even utilize those funds while lying in another institution. The other thing you find, we just give a facility to our customer. We don't bother to know who are there. For example, an SME or micro customer. If it's a micro customer, we don't really bother to reach out to their suppliers and know who is their supplier. Could we bank them? Could we be could they deposit their funds with us? Could they keep their resources with us? Why am I giving all that analogy? I just want to emphasize on the importance of not just receiving the tail of it. We must focus on the entire ecosystem and make sure that we are banking everybody in that chain, starting from the supplier to the micro customer who takes the loan, and making sure even this micro customer channels their deposit through us, even if it is 20 shillings per day. We need to inculcate a discipline of where these borrowers are banking with us. The suppliers to these borrowers are banking with us. That way we shall have a watertight system that will protect us as financiers. It will protect us as the financial institutions from a risk of just giving out your money without securing it with a deposit, because you're just giving the tail end of it without being keen enough to reach out to these other people who are part of this borrower who comes to you. The other thing you find, some institutions are not able to really raise their liquidity. They depend on financing from other financial institutions. But this institution must develop a strategic plan that probably as we move to our first year, to our second year, to our third year, we must be self-sustaining. Or even if we are not fully self-sustaining, we must say by the time we do 3 years of our strategic plan, we want to be at least 50% self-financing, with one deliberate goal, that in the long run, you will be self-sustaining as an institution. If you also find yourself a banker or a key depositor, ask yourself, be alive to the fact that this key depositor one morning could wake up and pull out their deposits. That is why, as a financial institution, you must say that, as I've mentioned earlier, let me benefit from the value chain. Let me make sure that I don't overdepend. Maybe in your initial years, you can overdepend, but this should not be the norm. As you survive, as you move into the years to come, you must be intentional about not being overdependent on any one financial of your deposits. Let us go into also lending. You find that probably because of the setup where your business was established, maybe you started your business in coast where your key customers happened to be the hotels or the sectors that are affected by the tourism industry. Ask yourself, how can we diversify and bank other customers? For example, a hotel receives probably chicken supplies from a supplier. Bother to know who are their suppliers. Bother to find out who are these other customers that we could tap into and run away from a concentration risk. We must run away from it. I am aware of institutions that tend to incline to only lending to a particular set of customers. Let us change our approach. Let us look at it differently. Let us partner. Let us support you to ensure that you run away from the concentration risk. Carol, that was broad, but yes, I just wanted to capture as much as possible.
Yeah, and just to basically recap some key things you have said, focus on the entire ecosystem. So don't just bank one customer and forget about what is the ecosystem. And I think that's very critical. There's something you have mentioned about focusing on not just lending, but banking the client. So that yes, when now you have the customer, you bank they also bring the deposits into your organization, which is, I think, one way to make that stable. There's something I think very critical on liquidity and how we finance the operations. You find that most some of the financial institutions, like you have said, they borrow money from other lenders, and that brings the cost of lending very high. And I think this is one of the other risks that you have actually mentioned in terms of having some place where you get your liquidity, but having very high cost of lending, and then makes that that another risk over and above the concentration risk. And so these risks are very interrelated. And I like the strategy of ensuring that you have a strategy to be self-funded from your balance sheet. And I guess that's a very important risk strategy as we look at financial institutions and how they can become self-funded and more sustainable. And these are strategies that can be thought through the risk management journey. The other risk that you had talked about is the risk of quick decision making, where you have decentralized decision making and people are not waiting for the central point to make a decision, and it takes 2 weeks to process some of this facility. And maybe you can talk through that in terms of what can we help financial institutions to do to be able to decentralize decision making, so that it is fast to be able to make decisions and fast to be able to conduct business activities. And I keep saying is that the faster we turn around we turn around the institution, many times we turn around the institution, the more profitable it is. The more you turn around the institution in terms of the money that you have. Once you turn it around many times, it becomes profitable. So maybe you can talk to that risk that we had mentioned on the decentralization and how that can work in a financial institution to help them manage their organization more efficiently.
Okay. From a lending point of view, we need to empower our teams on the ground. Let's give them discretions to make decisions on whether to lend or not. This could be capped to limits or to various sums of money, but we really need to give them the discretions to make decisions. Even on the deposits end, like I earlier mentioned, we are now going mobile. Everybody is banking on the mobile phone. So if you're seated and waiting for a customer to walk into your branch, you might be very disappointed. So can we have mobile platforms where we can connect and the customer is able to just immediately start wiring money to the bank without having to go to the field to fill forms, come back with forms, and the process takes so long. And the eventual effect of this is to find that if we are too slow, another institution will come and sweep the same customer. So let's allow our teams on the ground to make decisions. Let us roll the ball down there and give them. We could create reporting systems where we do reports. We can do pull out reports to just see what activities happened in which division. Let's have a use of MIS reports so that we can use them to review what decisions were made in a particular day, assess the success rate, and whatever succeeds, let's do it more. Whatever doesn't, let's review it. Let's not stop doing it. We review it, create the necessary controls, but still allow our teams to make decisions quick on the ground so that they remain responsive to the market, they remain agile and alive to the happenings in the market. An institution can be way in Northeastern and you are here in the capital. So if you have to make a decision in the capital and the person is in the other side of the country, by the time you keep conversing, that deal is gone. Let's empower our people. Let's review the processes. Let's make them work.
All right, thank you for that, Caroline. And maybe one of the things that we had mentioned earlier is non-performing loans, which are a big challenge to many financial institutions. In fact, earlier you had indicated that on the onset of COVID, we had a lot of challenges collecting loans. And this was due to the slowdown of the economy, not just in Kenya, but around the world. So, and I see that when you look at most financial institutions, whichever financial institution you look at, the highest, I see a lot of non-performing loans. And this is one of the challenges that these organizations have to face on a daily basis. And so maybe as we think through some of these challenges that these financial institutions face, maybe we can think through what are the strategies that our financial institutions can deploy to tackle non-performing loans, and what are some of the interventions in terms of risk interventions that they can be able to think through as they deal with this very big issue within the financial sector.
Okay. I think all of us, if not everyone, majority of us, you enjoy mobile limits, which some of the times you look at them and you wonder, really, did they really look at someone's profile before they really allocate some of these huge limits, which we don't want to discourage, but we want to intensify the fact that we need to assess our customers properly. We need to really be critical before we assign these limits. Most of the institutions have deployed the use of data analytics for them to allocate the limits. But let's take it a step higher, because you find that maybe the reason customers have certain sums of money flowing through is because of a windfall or something that is happening only at a particular time. Then the money is gone, and here you are, you use that cash flow to assign huge limits. Let's intensify, go beyond data analytics and check the credibility of these customers when we are allocating limits. Let's look at their credit information. Let us look at their scores. Let us not be quick to just allocate limits only for us to grapple with the huge NPL book that we've lent virtually and we don't even know where to locate this. Remember, history will always judge a customer. A customer who has performed well in the past is likely to pay you. A customer who shows a history of repaying their debt is more likely to pay you than a customer who has not probably borrowed before and you're not able to make a sound judgment. That would be a better candidate to bring into the banking hall for a physical decision, but not a virtual one. The other thing is that we can't run away from the fact that we've already lent out money out there and money is not being repaid. How many times do we reach out to know why did a customer stop servicing their debts, or you even notice they started servicing it at 50%? Do we bother to know what might have happened to their businesses, to their income? Open conversations with customers. Let's not be hostile. Let's be approachable, especially to customers who show some willingness to repay. Let's not turn them down and demand for the full payment when we know eventually if we don't engage them, this loan will become a difficult to collect facility. We could restructure moratoriums and many other things that we can do to support our customers. We could encourage them to dispose of their collaterals. We could refinance customers. I know people who are affected by the pandemic, they need support. Let's not turn them down. We need to look at them critically and say, do we refinance them? Do we support them? Do we hold them to go back to their original status? That is the only way we shall have a sustainable and a working financial sector and a well-managed. Also cap your NPL to a percentage and make sure that it is within a reasonable, manageable range that is not going to eat into your capital as a business. So also develop a parameter around it. I'm just avoiding to give a specific one because some institutions have as high as 15%. Others go as low as between the range of 7 to 10%, but essentially cap it so that you don't expose your capital into providing for non-performing loans.
All right. Thank you, Caroline. And I think that you have talked about very key points which are critical as we think about how do we assist manage financial institutions when it comes to risk management. And I think one of the areas that which is very critical, you've mentioned is know your customer. You need to assess your customer. And you have talked about limits, which are sometimes a bit ridiculous when you are thinking about a customer and the limit which they have been provided. And I like the idea that going beyond the data analytics. So we might need to be able to do that and see the credibility of a partner. And when somebody has got a windfall, how do we think through that windfall? And is it the one which determines how much money that you're giving out? I think those are key and critical points as we think about how do we assist our customers and assist these financial institutions. And I also like the fact about setting an NPL level, which I think for me is critical because we know that there are some financial institutions which then the NPL start affecting the capital, and that brings issues to do with the ratios that have the regulatory ratios that the regulators have set for these financial institutions to work within those limits. So I like that fact, and maybe we can think through some of the challenges that financial institutions face. But yet they have some auditors who are, statutory auditors who audit these organizations. And I keep hearing people say, by the way, we have XYZ auditors, but you know what? Our financial institutions still fail. Maybe we can think through, and we say that the auditors are very important to the shareholders, to the stakeholders, including to the general public on the work that they do as they do their audit services. Maybe you can talk a bit about that fact that we have. Why should this be one of the challenges that we face as financial institutions who fail, and yet they have this very important function that they have within their entities? Caroline.
I would talk about three things. We must have an internal audit system that is working. We must have an external auditor who plays an oversight role. We must also have a risk and governance system that is working. Do we develop a risk matrix? Do we put some of the exposures that we know are inherent, some of which we know that we can do something to reduce the general exposures that we have to these risks? So if I can talk about the internal audit, an internal audit is very good at housekeeping because it's like your own house. They know you very well. We must be able to have an empowered internal auditor who is able to come through your books and your records and tell you the truth and tell you, my dear, you're dealing with these non-performing loans, you're dealing with these KYC issues, you're dealing with these gaps that I feel you need to address them. And we must be willing to support our internal auditors. Remember, those are your colleagues. Are you supporting them? Are you bold to receive their feedback and correct what they're identifying as your gaps? When they tell you that your KYC is not good, matters the loans that you are lending, when they tell you that you didn't follow the due process, probably in evaluating the collaterals that you're using, are you bold enough to receive their feedback and correct those gaps? The other aspect is the external auditor. External auditor is a good oversight person, but the challenge we have with external auditors is that they are like visitors in your institution. They come, they identify the weaknesses that we have. A lot of times we are busy negotiating with the auditors, telling them to overlook this, to kindly moderate their words, moderate that. Can we also be willing to receive the feedback that the auditors are giving us and develop tracking systems to close on those gaps and reinvite them to come and assess the closures and make sure that we are fully compliant? Remember, some of the institutions that failed, they've been audited before. We've seen those records are out there. They are well articulated. But what happened is that these institutions sometimes probably did not give a full disclosure, and the auditor is at a disadvantage because he's an outsider. So let's be willing to fully disclose what we have in our records, and more importantly, be willing to receive that negative feedback boldly without waiting for an institution to fail. Let's deal with the insider lending business and be alive that the money that we are dealing with is for our customers, and we must ensure that we adhere to the guidelines that are provided for. Then let's make our risk and governance work. Let's be alive to our risk. Do we have risk registers? And if we have them, how often do we update our registers? How often do we review the risks that we listed a year ago and make sure that we are mitigating every exposure, every other now and then, to ensure in the eventual happening of it, we are fully secured, we are fully covered, we are not exposed as a financial institution.
Okay, thank you very much. I think there you have talked about the lines of defense, and that is critical in any financial institutions. We really need to depend on our internal staff. The process owners are very critical in risk management. They identify the risks and they need to deal with the risks. So risk management is critical in financial institutions. Then you have also spoken about the internal audit. The internal audit is a key function. Unfortunately, it's within the management and it reports directly to the board functionally and administrative to the CEO. But this function is extremely important. I actually believe that the risk function and the audit functions are critical for managing financial institutions. And these critical functions would help financial institutions from collapsing. And I think that that is a critical part of this discussion on ensuring that risk management and internal audit are critical functions that institutions need to have in place to ensure that we do not get into the failure of these financial institutions. And I think I like the fact that you have said an external audit is a visitor. They come just for a short time, they look at the historical data, and then they give you a report. But it's part of the process of oversight. So I think I would like to thank you for that. I will take 2 questions only, and then we can be able to close this session. We have been talking for the last 48 minutes. So I'll take 2 questions from the people who have joined us, and maybe from that, then we can close the session. So I don't know if there is anyone who would like to ask any question. You can unmute yourself, or you can just raise your hand and I can see your hand and then we can just moderate. We only have 2 minutes to do that, then we can close this very important session. Any takers? Dr. Roa, please, you can unmute yourself and maybe ask a question. We can't hear you. I don't know why we can't hear you.
Can you hear me now?
Yes, but you sound very far, but you can proceed.
I hope you can hear me now.
Yes, we can.
Yeah, my question is, a lot has changed over the years. The external environment has become a lot more sophisticated and complex. I think if you look at the world, the banking world in the last 50 years, it's still.
We can't hear you. Caroline, can you hear Dr. Roa? You need to speak a bit louder, or I don't know what's happening.
Let me try one more time. Can you hear me now?
Yes.
Yes.
Yeah, I'm saying a lot of things in the external environment in the last 30 years. Carol, you can hear?
Yes.
And the bank has remained largely conservative. My question is, has the philosophy of risk changed over that period of time based on the changes we are seeing in the external environment?
Okay.
Can I?
Please try and then I can come in after that.
Okay. A lot has changed. I totally concur with him. And that's why you're finding even a bank that is not alive to the changes, the digital landscape in the market, that bank cannot survive. That's why we must embrace the changes in the market. We must use data analytics, as I said earlier. That's why you're going away from just the normal appraisal of debts to using data, just that we need to take it a step higher. The risk aspect of it is that we are dealing with virtual customers. And with that in mind, we must be able to do thorough scrutiny in our customer engagement. There is no need to fear. We can take risk as long as the risk that we are taking is well governed and it is within a reasonable margin of exposure. For me, let the banks continue being agile, responsive to the changes in the market. Otherwise, you will close shop if you're not going to respond and change as the market changes. The other thing is avoid overexposing your business, inclination to one sector, or if you're lending to startups, make sure that does not take a huge chunk of your customers. Be alive to the risk that comes to every exposure that you take.
All right, thank you, Caroline. And I think that, yes, times have changed. I think as you've also mentioned, technology, things are moving quite fast. We're in a global village. Something happens in the US, and in Africa, it affects all of us. So I think that because of the fact that we are living in a global village also changes the risk profiles of our organization, because if something happens in one place, it affects everywhere else. So I think that risk is a discipline that would be able to address some of these challenges that we are facing in the marketplace. And the reason that this discipline of risk is very critical as you look at sustainable financial institutions, and not just financial institutions, all other organizations need to embrace risk as a discipline which they then inculcate within their organizations. So I don't know if there is any other question. I have 1 more minute. I don't see a question. I don't see a hand. I'd like to thank Caroline for having this fast discussion, Caroline Mutungi. Thank you very much for engaging us during this 1-hour session. This session is the first episode, and we're hoping to do many other episodes to be able to create awareness on risk and how risk can help organizations manage and maneuver on a regular basis. And I'd like to thank everybody who has joined this session for joining us and for engaging with us. And I would like to let you know that we'll have a next risk awareness session in the month of April, and we'll be sending out information about it. And we thank you so much for engaging with us. At this point, I'd request Sibyl Kahuria to come through and finish up the session. But thank you very much for engaging us and for keeping us engaged in this 1-hour session. Sibyl? We can't hear you, Sibyl. Yes, proceed. Can you hear Sibyl? Sorry. Caroline, can you hear Sibyl?
No.
We are not able to hear you, Sibyl. I don't know if it is your... Okay, we can't hear you, Sibyl. I think you can just put up the few slides and then we can finish. I will take it through. Your slides? Okay, great. All right. Please put them on SlideShare. Okay. All right, just to finish up, just to speak to some of the services that we provide. Give us a minute.
We can't hear you. Carol, we can't hear you.
You're muted, Carol. You're muted.
Apologies for that. Sorry for that. Just to speak to our services that we provide services in risk advisory services. So we develop risk enterprise frameworks for organizations we work with. We conduct risk assessments and due diligence services. We also develop risk policies. We also help organizations implement risk support in terms of ensuring that they are able to identify their risks, they're able to mitigate their risks. And then we have a risk system called the Risk Tab. The Risk Tab is a cloud-based system, and it helps document, manage, and monitor risks for organizations. We also have risk training. We have a one-day risk awareness training, which we conduct for organizations. We can be able to tailor-make this training for the board. We can be able to tailor-make this for risk professionals within organizations that we work with, and we also tailor-make different risk trainings based on the liking of the customer. So those are the services we provide. We have an upcoming activity on 30th of March. This is a service that we provide for free. It is on 30th of March between 5 p.m. to 6 p.m. We'll be talking about the risk management policy, and we'll be taking 1 hour between 5 and 6 p.m. on 30th of March as we help our clients and organizations understand risk. So those are some of the things we do, and we'd like to conclude this at this point in time. And thank you all of you for engaging with us. I'd request my team to post our contacts on the chat box. You can engage with us at any time. You can connect with us on LinkedIn, and we can be able to be of help to you. So I'd like to conclude this session at this point in time, and thank you everybody for joining this session, and we hope to see you on 30th of March as we do the risk management policy training on between 5 p.m. and 6 p.m. We'll have another risk conscious talk in the month of April, and we will be sending the details of that talk through our social media handles and through our LinkedIn. So thank you very much, and have a good rest of the afternoon, and thank you.